And now we want to look at the inventory quantity adjustment form. So first, quick recap on inventory, because once you level up or once you have inventory within a business, you have to ask the question of how you're going to be dealing with inventory, how you're going to be tracking that inventory, and that will also tell you how you're going to be entering that inventory into the system. For that, let's take a quick recap of our flowchart. This is a desktop homepage flowchart. I know we're using QuickBooks Online, but we're just looking at the flow of the forms, and this is a beautiful, nice flow of the forms for any type of accounting software or system, which basically will have similar flows. So if we have inventory, we're going to have to purchase inventory, which is going to happen on the purchasing side. So you can think of it as going through the vendor cycle or purchases or expense cycle. And it's also going to have a revenue side of things, because we're going to move it from inventory, the asset, to the expensive cost of goods sold when we sell it, that being an accrual process, typically with the use of the form of the invoice form and the sales receipt. Now, in order to do that on what we call a perpetual inventory system, it's somewhat complex to set up within QuickBooks, because we have to set up not only the inventory account tracking by dollar, but also by inventory items and units of inventory items. So for example, when you scan something at a grocery store, we see the dollar amount that it's going to cost, but the system is also recording on a perpetual inventory system the reduction in the inventory in dollars as well as in units and the related cost of goods sold. So that would mean that we would have to set up the inventory items within the QuickBooks system. And when we purchase the inventory items with a bill form or a check form, it would increase not only the dollar amount of the asset account of inventory, but also the units of inventory by item. And then when we sell the inventory with an invoice or sales receipt, those are the forms that we would typically have to use, because they would give us the items, allowing us to then reduce the inventory at the point of sale, not only in dollar amount, but also in terms of units on the subledger. Now, you might come up with a system and say, well, I don't want to do that within QuickBooks. It's too tedious, or possibly QuickBooks doesn't have the level of tracking inventory needed, and possibly you're going to be using an outside software. So for example, if you have a Shopify store or you sell stuff on Amazon or something like that, you might be tracking the units in that other software, or possibly in Excel or something like that, and only periodically adjusting the dollar amounts in QuickBooks, with basically adjusting entries possibly at the end of the year, at least for taxes, or on a quarterly basis, monthly basis, or weekly basis. You can imagine if you're at a food truck or something like that, or you sell items from a truck or something like that, that you would count, you'd actually physically count the items, right? And then you can determine how many you sold by doing the good old cost of goods sold calculation. You've got your beginning inventory plus your purchases. That's the goods that you have available for sale, minus the ending inventory. The amount that you count at the end of the day gives you the amount that basically you sold, and you might periodically put that into the QuickBooks system, thereby not tracking the units of inventory, but periodically recording the cost of inventory in the QuickBooks system. So we're imagining here, for the purposes of our inventory adjustment form, that we're using a full perpetual inventory system. We're tracking the units of inventory within the system. That's usually the best internal control that you can have, because now the system is tracking the inventory as you buy it and sell it. And you might say, well, if the inventory is being tracked, I don't need to do a physical count anymore. But you still, of course, need to do a physical count, because you have to tie out your system to reality. That's what the internal control will be. And if you live like anywhere, like located where I live, for example, you have at least a few scumbags out there that would be willing to, rob their own grandma for a half-eaten sandwich as she's crossing the street and not have a second thought about it, right? So you got to deal with shrinkage. There's going to be possibly theft within the system. In California, they just let you steal the stuff, right? So there's going to be shrinkage, almost for sure. So you're going to have to do a physical count of the inventory so you can determine how much stuff the crazy jerks stole out there, and then you're going to have to write down the inventory periodically. So a full internal control inventory system is going to record the inventory increases when we purchase them with a bill form or a check form. It's going to record the decrease of inventory in dollar and units when we sell them, typically with the sales receipt form and the invoice form, and that will track the inventory. But then we're also going to do a physical count at the end of the night, the end of the week, the end of the month, the end of the year to determine how much stuff the crazy people stole or how much spoiled or whatever else happened. And then usually the physical count is going to be the same or possibly less. Oddly, it could be more if there was an error that happened. And then we're going to have to write down the inventory to the physical count that's actually there. We can't say, well, the system's right and my physical eyeballs are wrong. I counted wrong. No, the physical eyeballs are wrong. If the system says there's 20 units and you counted 15 units, something happened. Something got spoiled. Someone stole something. There was an error in the data input. You've got to deal with reality and deal with the new inventory system, the actual physical count.